The most efficient and transformable form of BTUs on the planet are oil and gas. Will we need alternative energy? Yes. Will we need coal? Yes. Will we need nuclear? Yes. Will we need distributed storage? Yes. And will we need oil and gas? Yes.
Breaking news. Conflict minerals are coming under heavy fire. You see, 60% of the world's cobalt comes from Congo, a region making billions leveraging the use of child labor for the production of crucial minerals that enable our electronics. Already existing supply shortages could get extreme as new executive orders have been drafted to cut off the use of minerals such as cobalt from this region. The clean energy trend is unstoppable, and cobalt is a crucial component. Savvy investors ready to fully experience this undeniable revolution need to visit crushthestreet.com/cobalt17. Hello everyone, and welcome into crushthestreet.com. My name is Kenneth Amaduri, and my goal today with this show is to put the resource market in metals into perspective, because I know many are feeling the pain since August and September of 2016. So I brought on the line legendary investor Rick Rule of Sprott Global, really one of the greatest stock pickers in the resource market to ever live. And he's on the phone with me today. So Rick Rule, thanks for joining me.
Always a pleasure, Ken. Thanks for having me on your show.
Absolutely. Well, I'm looking at the gold price. We're up a couple $100 since its low, and same thing with silver. We're up from the low, back in 2015. Base metals are taking off. Zinc, copper, lithium, and cobalt are all thriving. And I guess because we had such an exciting first half of 2016, we weren't expecting things to correct so quickly and so hard in the resource sector. So like I said in the introduction here, I want to talk about, the perspective, putting this into perspective and getting some understanding for investors here.
Well, Ken, our expectations were the problem. We enjoyed too much too fast last year. And we talked about that on your show last year. Ken, if the underlying fundamentals of a company don't change and the company doubles in price, while that is pleasant for us, from an arithmetic point of view, the doubling in price makes the outlook half as attractive. I am myself more attracted to this market precisely because the equities have fallen in price while the commodities have done well. The bad momentum belies good value fundamentals. It's always important to remember also, Ken, that statistics related to the market relate to the whole market, and that in and of itself is misleading. In the juniors, as an example, there are between 1,800 and 2,000 publicly listed juniors around the world. The vast majority of these juniors are valueless. Probably 80% are valueless. Only 20% of the listed juniors add respectability and sometimes luster to the whole market. The fact that the whole sector last year gained in price when only 20% contributed to value is instructive, particularly when you look this year at the fact that the destruction of market capitalization has not been ubiquitous. The best of the best juniors have done well this year, while the flotsam and jetsam have suffered to the extent that one rationally would have expected. This is as good a setup as I've seen for a very long time. The underlying fundamentals have improved, but the price of entry has declined. If someone is looking to get wealthier, they need to add assets, and the fact that they're on sale is a benefit, not a cost.
Right. So it sounds like you're confident that we're still in a bull market. I think a lot of people are worried that, hey, we're going back into a bear market. And I'd like for you to comment on the flow of capital that we've seen companies do with their finances, because I think that lends itself to some credibility as to, how confident they are that prices are going up and there's value to be had in the current environment.
Well, I don't mean to contradict you, but the companies are almost always willing to take capital. it is easier for them to do so during ebullient markets. But the incredible ease with which companies were able to raise capital last year, from my own point of view, is a negative. You had aggregations of butchers, bakers, and candlestick makers forming companies based on projects that had failed in the last three bull markets, able to raise $10 million on nothing more than narrative. This is destructive of a market. This takes capital away from more deserving juniors. Now, of late, that is in the last 6 months, the generalist investors, the momentum investors, have again backed away from resources, and this has led to a dampening of the animal spirits among momentum-oriented speculators, but that's all good too. The high-quality companies that need to raise capital can raise capital. In fact, the capital allocation market is extremely competitive for the best of the best issuers. We see right now the retreat of the dumb money, the momentum-oriented retail investor, the small generalist institution, and we see the emergence of the smart money. Large mining companies, as an example, taking private placements in high-quality juniors. The best of the best resource-oriented institutional investors eager to make long-term capital investments. Investment allocators like pension funds, insurance companies, and sovereign wealth funds, rather than capital aggregators like mutual funds, beginning to dominate the market. This is a market, Kenneth, that is healthy indeed, just not ebullient.
So does this time around, this current market cycle environment, can it be compared to any other time that you've seen in the resource market? And can you talk a little bit about that, and just to give us some perspective of where we're at, and historically, and if history is going to repeat or rhyme, what we can expect?
In a very broad sense, I would say that it rhymes. A broad sense meaning that the incredible bull market, which we enjoyed last decade, gave way, as it always does, to an incredible bear market. The excesses of the bull cycle had to be exorcised from the market. And exorcised they were. The TSXV, the index that we compare ourselves to, was off by almost 90% in real terms. And the recovery that we saw last year, the dramatic recovery, was in one sense merely a bounce from deeply oversold levels, a bounce that was violent enough that it in fact caught some momentum investors who in turn got trapped. The fact that the bear market was the author of a bull market, and the bull market will ultimately become the author of a bear market, is something that has been consistent throughout my 40-year professional career. But the details are different this time. Some of the details are the willingness of institutional investors to go much further down the quality chain in the market. Traditional bull markets have been led first by the metals, then by the largest producers, then by the secondary producers, and then finally by the juniors. This market has been different because there have been increasing amounts of capital available all the way down the feeding chain. It's also different because of the emergence of a new speculative vehicle, the exchange-traded funds, which are available in the junior sector of the market, not just the senior sector of the market. So suddenly, there are $7 or $8 billion of buying available in the very small sector, which means that the small sector actually outperformed the large sector in the early stages of a bull market, which is something that I haven't seen before. So yes, while the basic fundamentals in terms of the market are the same, the market mechanisms are now different.
Rick, I'd like to switch gears here slightly, and I'd like to talk to you about cobalt. This is a commodity that goes hand in hand with lithium and the clean energy trend, which is really undeniable. And the batteries, talking about lithium-ion batteries, what are some of your thoughts in terms of opportunity that exists in the cobalt space?
Well, it's interesting that you bring that up. We get more questions about batteries than we do about the rest of our investment business combined, which is actually a little silly. But since we get these questions, I'll deal with it. First of all, the lithium-ion battery is about 1.5% by weight lithium. It's a copper nickel and to a lesser extent cobalt battery. And lithium is in fact in global oversupply worldwide. The prices moved up because demand moved up before the existing producers could debottleneck their supply chains. But the idea that there's a pervasive lithium shortage at any level of demand is farcical. There is a shortage of processing capacity with regards to existing supply. In cobalt, the situation is very, very different. In terms of cobalt production, two things or 2.5 things matter. The first thing that matters is Congo. Cobalt is produced primarily as a byproduct of copper in the Katanga cobalt belt, copper belt, pardon me. And political stability and continued production from the important Katangan copper deposits is the most important supply source of cobalt. The secondary source of cobalt is, of course, Russia. So what matters to cobalt primarily is Congolese and Russian supply. There is also substantial byproduct cobalt production from ultramafic deposits, nickel deposits, platinum deposits, and other things like that. What's interesting is cobalt is one of those unique materials, perhaps like scandium, where ironically, if the production capacity increases, demand will likely increase too. Build it and you will come, if it were. We've had numerous discussions with groups representing fabricators who say that if the supply of cobalt, that is the stability of supply increased, that fabrication demand would increase because it would be worth fabricators' while to incorporate cobalt if they were sure that they would be able to obtain it. Now, as an investment theme, cobalt is going to be particularly tricky because investors will want to invest viscerally in cobalt activities in political jurisdictions that they can trust. Examples would be Canada and Australia. The problem with that is that history teaches us that when you invest in commodities, you look for high-quality, low-cost supplies. And the Western world, particularly Canada, will always be, at the very best, a marginal supplier of cobalt. So the investor who really wants to play the cobalt market, rather than his or her own political preferences, will have to accommodate themselves to the fact that if they want to be a cobalt player, they have to be a Congo player or a Russia player. If you're going to be a Canadian cobalt player, that means that you have to be a trader. That means that you have to speculate on lousy deposits managed by stock promoters who 10 years ago couldn't spell cobalt. I'm not trying to say that that isn't a bad speculative technique, but it's not an investment technique. The interesting, the interesting compromise might be Australia, where you look at deposits like Syerston, fairly good-sized deposits, fronted by people like Robert Friedland, who have been able to spell cobalt for a very long time. I see cobalt as being a sort of a mini commodity boom, like you've seen so many times in Canada, where a new material that the market doesn't have experience with and as a consequence doesn't have a bad taste associated with it, becomes a sort of a fad, a commodity-based area play. So while the reality of cobalt is extremely attractive to me, the reality also is that most speculators who don't understand the market will ultimately be destroyed in the cobalt business.
Yeah, no, that was very well put. I'd like to also get your thoughts on fossil fuels here and just the clean energy trend. I mean, we have Elon Musk talking about power walls, these devices that go on our walls and power our homes, solar panels on every house and every building, and with nuclear power. Is traditional fossil fuels, are they destined to be on the downtrend from here on out?
The easy answer to that is no. The most efficient and transformable form of BTUs on the planet are oil and gas. Will we need alternative energy? Yes. Will we need coal? Yes. Will we need nuclear? Yes. Will we need distributed storage? Yes. And will we need oil and gas? Yes. There's 7 billion of us on the planet, Ken. There are about 2.5 billion that enjoy roughly the same lifestyle that you and I enjoy. And the other 4.5 billion aspire to that lifestyle. Those of us in the Western world, whether we choose to or not, are willing to subsidize alternative energy, willing to subsidize inefficient, at least capital intensive, capital inefficient energy. But the rest of the world doesn't have that luxury. So if you look forward over the next 10 years and you believe that the longest running bull market in history, that is the ascent of man, is intact, what you understand is that energy consumption will grow inexorably. All forms of energy demand. That is politically correct energy, things like solar energy in Germany and Canada where the sun doesn't shine. Things like wind energy, where although the operating cost is nil, the capital cost is very high. But also the politically unpopular forms of energy like coal, where worldwide demand is actually increasing. Nuclear, and of course, oil and gas.
Well put, sir, and your thoughts are always greatly appreciated. If people want to learn more about what you do and be able to reach out to you, where would they go and what would they find?
As always, the special offer to Amaduri subscribers. I would love to visit with your subscribers, and I offer as an inducement an absolutely no obligation ranking of their natural resource portfolios. If they send me their portfolios in plain text with both the name and the symbol of the companies, and send that email to contact, CONTACT, at sprottglobal.com, attention Rick Rule, I will send back those portfolios with the companies ranked. Understand this isn't investment advice, these are company rankings. But I would love to visit with your subscribers in terms of their portfolios and how they're suited to their own needs.
Absolutely. Well, Rick, thanks for coming on the line with me today. I really appreciate it.
Always a pleasure. I look forward to it again.